What's up, everyone? It's Scotty with MoneyVest. So in this video, we are going to be talking about S&P Global, ticker symbol SPGI. A lot of you guys have been asking for an analysis and an updated video on this company. So we're going to break this down. I'm going to go over everything you need to know from a fundamental and technical analysis standpoint to better make a decision whether this is a buying opportunity for this stock or not. As always, all I ask in return is that you drop a like and, of course, subscribe to the channel if you're just joining us for the first time. And link to our Discord and Patreon is going to be down below if you're interested in joining. And of course, get access to all the buy and sell alerts, options alerts, members only private videos, Excel spreadsheets that you can download, and also the TradingView charts. And I'm introducing new stock reports that you can also download from Patreon as well. So links are going to be down below and we'll love to have you on board. So first things first, let's talk about 1 year ago. I did a video on this very stock. This is a very high quality stock. Buy at this price. This was the video title and one high quality growth stock that we analyzed 1 year ago. You can go back and watch that video. I'm going to play a clip from that video to help you better understand what my thesis was 1 year ago, back in July of 22, and how the stock price performed after and how it's been updated from 1 year ago. So it's always nice to kind of go back and basically go over, our analysis and talk a little bit about how it's been revised. So again, you will notice that we were talking about S&P Global back then. So I'm going to increase the volume for this video, which again came out on July 16th, 2022. Very high quality stock. And again, we're doing the analysis. And at the time, we basically accounted for about a 14% growth rate for S&P Global and about a 20 times PE multiple. And the fair value was at $265, right? That right there was the price, the intrinsic value with our flexibility range, which wasn't there at the time. But the market price obviously is $349 at that time, right? And right now, if you come over to S&P Global, it is trading at around $356. So not much has happened in the last year. So again, if you go back to July of 2022, so this right here is when that video came out. It's basically flat in the last 1 year. In fact, it did drop down to $275. So not exactly at $265, but it did drop 23% after the video came out, and we were almost at that fair value of $265. And since then, of course, we did rally quite a bit of 55%. So I'm going to reevaluate and, of course, take a look at where this company is now valued. But let's just quickly break down the thought process and the analysis from this video, and then I'll jump back over to my updated analysis. So let's do this. Dollars a share, and then of course market price sitting at $349 represents another 24% potential for downside here for the company in the future. So that's where we are with S&P Global. Keep saying S&P 500. This is where we are with the S&P Global company. Like I said, very high quality name. Like this is one of the best when it comes to revenue consistency, earnings growth, EBITDA, free cash flows. Margins are very solid. The only little drawbacks, only few key areas to work at are going to be the balance sheet. So they've got more debt than cash on the balance sheet. Another thing is valuation. It certainly needs to come down. And the third thing is our conservative estimates are pointing us to sub 250 to closer to 240. 240 to 250 is going to be that fair value according to my estimates on S&P Global. So if it does come down and sell off even further, in my opinion, S&P Global is a quality stock that I will be buying at those levels all day long. This right here is going to be our full breakdown and our full analysis. So revenue growth, absolutely there. Margin expansion, a huge check mark. Profit growth. So what you'll notice is obviously, baby caddy over there. But this right here were the actual numbers, right? Revenue growth, margin expansion, profit growth, EBITDA, free cash flow, low dilution. Now, there are certain things that have changed since then. Low dilution is no longer the case. In fact, the company did issue some shares here, which I'm going to break down. And this right here, the low debt levels and the fact that the valuations is still a little bit more expensive for the company still is true right now. And of course, technicals are very solid. And based on the forecast, we'll take a look at where the fair value ends up being. So this right here is the updated spreadsheet. By the way, very quickly, S&P Global is a rating company that does a lot of ratings for, customers, all over the world. So if you come over, take a look. So it's a leading provider of transparent and independent ratings, benchmarks, analytics, and data to the capital and commodity markets. So they've got S&P Global Ratings, S&P Global Market Intelligence, Dow Jones Indices, S&P Global Platts. Global Ratings assigns credit ratings to government agencies, companies, and the borrowers. And Global Market Intelligence provides data and analytics to financial markets. The information is used by investors to make investment decisions, by corporations to manage their businesses, and by government to make policy decisions as well. So, they basically compile a lot of data. They do a lot of ratings, a lot of very, very intelligent information insightful, valuable information that they provide to their corporate clients, to their individual customers, and a lot of other folks, including governments and enterprises all over the world. So that's really where, S&P Global shines. But they have obviously been doing a little bit of some senior notes offering. They've been taking on some debt because they did do one of the biggest fintech market acquisitions in the world at over $44 billion, buying IHS Market, which I'll go over in just a minute. But $750 million senior notes were issued. This is back in September of 2023. And diluted shares outstanding also did increase. And I'm assuming that happened because of the $44 billion acquisition for IHS Market. Because in my previous video from 1 year ago, you'll notice that what I did take into account was the share dilution basically going down, meaning the company is going to be buying back shares. But this was quite surprising that, we were going on this nice consistent downtrend and then a huge spike in 2022. So you can see that bar graph pushing higher with some issuance of shares because of the acquisition. Total debt and net debt also, you can see pretty substantial increase, right, in 2022. And that's because of that acquisition again. And goodwill on their balance sheet is also another potential yellow and / red flag. And the reason I say this is because take a look at this, very, very flat, pretty much non-existent intangible assets, and then a huge spike in 2022. And now the thing is that goodwill and intangibles make up over 80% of their total assets, right? And that's probably because of the market value of their acquisition of IHS Market. Now, if that market value starts to decline, right, something similar to that's happened with, a lot of these biotech and medical firms that have bought, different companies and their market value has declined, that's going to put a significant impact on overall earnings, because this is again going to be a non-cash expense for the company, which is going to help them lower their actual profitability to pay less taxes. But this is a, somewhat of a concern. It's good because the revenue is growing and it's moving in the right direction, but obviously the market value needs to hold up pretty well. So S&P 500 or S&P Global, completes merger with IHS Market, creating a global leader to power the markets of the future. And this right here was something that CEO Douglas Peterson says, and I quote, "We looked at how we could leapfrog and accelerate and actually be transformative with the data and analytics we provide to our customers in all the spaces that we see as the fastest growth areas. We identified IHS Market as a partner across the board, and the opportunities are really fantastic," is what they also mentioned. So they acquired them for about $44 billion deal, which again at the 2022 is a very, very high number in my opinion. I think I remember doing a video about this back then, but the bottom line is, of course, goodwill, total debt, net debt, shares outstanding, everything, like some of those metrics that we look for have spiked quite a bit in the last year. Now, when it comes to the revenue, they have grown really well to 10% here compounded annually. So that's good. Gross profit has been increasing by over 10%. We've got operating income that's up over 10.7%. Operating margins are up 1.89% to 35.45%. Gross margins are sitting at over 66% for the company. Net income is also up by 10%. So we've seen revenue, profits, operating income, net profits, everything grow by about 10% on a compounded annual basis. Net margins are slightly down, which, I'll just give them as a good check mark there because it's only down 21 basis points. And operating cash flow is also up over 18.8%, with operating cash flow margins that are expanding over 11.5%. So very strong growth there. CapEx is still really, really small, only under $100 million. That's only about 1% of the total revenue. So that's pretty strong. Free cash flow jumping over 6% per year to over $3.5 billion as of 2022. And I think in the year 2023, they're expected to do a little bit over $4 billion. And free cash flow margins has been coming down. So it's come down from 43% down to 31% for the company. And then finally, earnings per share also increased by over 8.4% per year. And shares outstanding, unfortunately, are up 1.45%. So most of the things here are good for S&P Global, right? I mean, they're pretty solid from a growth and profitability standpoint. Now, balance sheet is when things start to get really interesting because short-term liquidity is pretty poor. So you are looking at a less than 1 times current and quick ratio. Debt to free cash flow is a little bit over 3, which is not necessarily a red flag, but definitely a yellow flag because we like to look for this number under 3 because debt has gone up. Free cash flow is also growing, but not at the same rate. And we got total assets over total long-term debt very solid at over 5.6, 5.7. Net debt to EBITDA is 1.5, so that's good. We look for this number under 3. Cash to debt really, really low. So if you come over to how the company's transformed, in 2013, they had negative net debt, meaning more cash than debt on the balance sheet. And now they're sitting on $7.5 billion of net debt because long-term debt's at 10.7 and cash is sitting at 3.2. This includes their long-term investments as well. So net debt is a positive number, and we don't want that. We always want it to be a negative number, meaning more cash than debt on the balance sheet, because net debt is nothing but debt minus cash. And if debt minus cash is a positive number, that means that the company's got more debt than cash on the balance sheet. So for that reason, that is a bit of a concern, and that's obviously coming on the back of the $44 billion acquisition the company did. Now look, if the revenue, the earnings, the cash flows, everything starts to materialize in the next few years after this acquisition, if it starts to kind of accelerate further, then this cash can be paid down pretty well, and it will come off of free cash flows, but that needs to happen, right? They need to be able to execute and materialize those numbers. And that's a little bit of that uncertainty there. But iJust Market is a pretty well-known market intelligence platform in itself, so an acquisition with S&P Global, I think it's a good combination. I think it's a good partnership that they'll have. Total assets, now this is another that's a bit of a concerning factor, is that total assets are $61 billion. So even though they have 10x'd their total assets from 2013 to 2022, total liabilities have also gone up, 21% on a compounded annual basis. The problem is that goodwill plus intangibles, this right here is what I want you guys to focus on. This has gone from $2.5 billion to $53 billion, right? So if you come over to their balance sheet, I mean, that is a lot, right? If you think about the overall goodwill here, total assets, and then over current assets, actually non-current assets, we're going to be sitting at net intangible assets right over here. So that's going to be part of both goodwill and other intangibles, right? These are things that you can't quite see, touch, or feel. So net intangible assets represents the net asset value of all assets that are beneficial to companies but do not have any physical attributes, right? They're not physical assets. These are just values on paper. That's it. And that's what's sitting at $52 billion. $52 billion off of their total assets, which is at $60 billion. You do the math. How much physical assets the company's sitting on. 52 divided by 60 over 86%. That's exactly what I have over here. And that's what I'm going to point out. 86% right now is in goodwill and intangible assets for the balance sheet, right? I mean, only 8%, or in fact, I would say 14% of assets are actually physical assets with physical attributes. These are cash and investments. These are hardcore cash and property, plant, equipment, and other receivables. But that is a bit of a concern. Again, like I said, they acquired iJust Market. That's why it's going up. And it's gone up, it's doubled since 2013. So from 41 to 85%, that's a pretty substantial number. But all I'm going to say is just understand that this acquisition can obviously be a make it or break it deal for S&P Global. And if they can actually materialize this into higher revenues and higher cash flows, then by all means, I mean, they can pay down the debt. And they're going to build that equity into the balance sheet. And as a result, this goodwill is going to be worth something. But, it's really going to come down to execution at the end of the day. But other things like short-term liquidity, like I said, bit of a flag there. Interest coverage ratio is good. Solvency ratio is also good. And shareholder equity has also grown tremendously by over 38%. So there's a lot to like here, but there are certain things that I just wanted to point out before, you guys decide to actually start going into this. But just some things that I wanted to mention for them. Now, when it comes to efficiency, they have decreased. Actually, I wanna update the market cap for S&P Global. So market cap right now is going to be 113,413. So 113,413. So we are right now sitting at a pretty decent return on equity here. So let me see. That's going to be, so return on equity and everything. I just want to make sure that is indeed correct. We're going to go over to Seeking Alpha here. So let's just go over to profitability. We're looking at a return on common equity of about 6%, return on capital of about 5%, and return on assets of just under 4%. So, those multiples are really, really low. Like in terms of the return on assets employed and return on capital employed, return on invested capital or return on capital is quite decently low. I mean, it's reasonable, I guess. 4, 5%, 6%, 7% is quite okay. But it has come down from its highs, and it's also not the best, right? For a software company, it's not the best. Now, another thing that I want to mention is employees, right? They have more than doubled their employees from 17,000 to almost 40,000. But revenue per employee and net income per employee is stagnant. It is flat. It has not grown. In fact, it is one of the very few times I'm actually seeing that it is almost exactly the same as what they had in the past. So, I mean, according to their analysis, but this is also based on a 5-year average, 108,000 going down to under 59,000, 60,000. So what does that tell you? That tells you that S&P Global's profit per employee has gone down, meaning that either they're overhiring or they are not utilizing their employees to generate a higher net income. One of those two things is happening, and the numbers can clearly state that. When it comes to the valuation, now valuation is high. They're trading at about 34 to 35 times earnings, a little close to 9 to 10 times sales, enterprise value to EBITDA of 24, and price to free cash flow of 32. So, needless to say, the valuation multiples are high for this company, which the growth really isn't as expected to be that much, right? The growth is expected to be 12.5% for the company over the next 4 to 5 years. So even if I'm being generous with, S&P Global, like let's just go with about 14% growth here. I'm going to go with 25 times PE multiple. I'm feeling generous today, 20% free cash flow growth, even though actually 20% may be too high. Let's just go with about 16%, even though they've only grown free cash flows by about 6%. In fact, let's say in 2023, their free cash flow is going to be 4.3. That's about just under 8% growth rate for the company. So I'm actually going very, very high at 16%. 20 times free cash flow multiple. I think we can go with an 11% discount rate because the company does pay out a dividend, a 10% margin of safety. Now, the share dilution is quite interesting because they were buying back shares up until 2022. So I'm going to keep this at 0. And the reason for that is because 1 year doesn't make a trend, right? 1 year doesn't do anything. They have been consistently buying back shares. Only 1 year they had to issue more shares because I'm assuming because of the acquisition of IHS Markit. And then we're going to go with 50% EPS, 50% free cash flow, and we come down to a fair value of $314 per share, and right now it's trading at $356. So it's still a bit of an improvement from what we witnessed last year when it was at 250s and 260s. So it's still a bit of an improvement, but you also have to understand that I'm definitely going with higher multiples and higher growth rates here. I mean, 14% S&P Global, maybe they can do 14%, no doubt about that. I mean, P multiple 25 is, I guess, okay. Free cash flow growth rate, no, I don't think 16% is reasonable. I think 10% if you go with that, and a 20 times P multiple, a price to free cash flow multiple, then we come down to a fair value closer to 278. So you have to really, make that decision of whether these growth rates make sense to you, or are you trying to paint a picture which is going to be higher. Now, if we go with the previous number, which was 16% and 20 times free cash flow multiple, $314. And if you are, let's say 9%, or 8%, and now we're looking at the fair value to be precisely the same as the market price, and that would yield about a 10.8% annualized rate of return, which I guess on paper and theoretically is market beating. So there's no doubt about that S&P Global has the potential to beat the market over the next 5 years or 10 years, but these right here are the assumptions that we're going with, right? I mean, can they actually grow free cash flow by 16%? Can they actually grow net income by 14%? In my opinion, there's a possibility, especially once you consider the acquisition of IHS Markit, that's going to accelerate the numbers moving forward. So given that, but then again, 8% discount rate is not something that I'm looking for. I'm looking for at least 12, and that puts our fair value once again at least down to 300s, low 300s are going to be some levels to pay attention to for S&P Global. So let me know your thoughts down in the comment section below. Now, when it comes to the technicals, we are certainly starting to see some more potential downside, and I will be watching this right here as a support at 317. All the way down to this right here is going to be that next really important support level in the low 300s, where I do believe there is potential for S&P Global at those prices. Now, a couple concerns I already mentioned. Balance sheet is one. Lots of goodwill as a percentage of total assets. Current ratio, quick ratio is quite low, so it's possible that they take on more debt, which we've already seen that they have been doing. So they did issue another $750 million worth of senior convertible notes. No, I don't think it was convertible. Principal amounts 5.25% senior notes due 2033, so in a private placement. So 10 years out, 5.25% corporate debt is what they're issuing to make sure that they don't run out of capital in the short term. So those are some concerns, but like I said, very, very strong company, high quality business. But there are some loose ends for S&P Global, and low 300s is where I would be looking for this company. As always, if you enjoyed it, found it helpful, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below. Happy investing. I'll see you all in the next video.